Hello and welcome to this last day of August 2023. My name is Tyler Wood. I'm a CMT charter holder. And today, as always, well, not as always, the last few weeks we've been missing you. Alex, welcome back. How are you doing,
Thank
my
you.
friend?
I'm excited to be back. Been a good week in the market so far, and everything's looking rosy.
You know, when Alex is happy and his family's on vacation, markets are doing better. So
Yep.
I'm going to propose that you just always live in the British Isles and
Yeah.
do some paddleboarding and enjoy
Right.
quality family time. It seems to be really good for the markets,
Yeah.
buddy.
We'll do some swimming with seals and island life, and just off the coast of Cornwall. And strangely, we had good weather, so it was everybody's happy.
Fantastic. Well, folks, as Alex mentioned, we've had some strong days in the equity markets here in the United States. Today, we're going to be talking about pullbacks within secular uptrends, how we can prepare ourselves for entry points when things really kick back into gear. But as we like to do each week, let's start at the top level across the asset classes, looking at the absolute trends.
Yeah, and you can just see that with that no-go correction that we've had in equity markets has given way to consecutive amber go fish bars. Now, that doesn't mean we're completely out of the woods from a trend following perspective. Remember, trend following indicators are going to lag turns in the market. That just makes sense because by the time we identify the trend, it has begun. But what it does show is that the hold the no-go had on the S&P 500 has given way to these go fish bars. And that's when we aren't getting enough criteria being met in either direction to categorically identify a go or a no-go. But certainly coming out of the no-go trend in equities, we can see that Treasury bond prices have stayed in a no-go trend, but that has weakened as equities have risen this week. Commodities, strong go trend. No change there this week. And the dollar still in a go trend, but painting a couple of weaker aqua bars.
Yeah, we're going to spend some time today talking about interest rates and the US dollar, two very significant headwinds to the equity markets and to risk assets broadly. Alex, let's start with a chart of the TNX. Last week, we were preparing for commentary from Chairman Jerome Powell. We got that Friday morning. Certainly, a lot of analysts seeing a more hawkish tone, a commitment to fighting inflation, not the we're done hiking rates. This is we're all clear. We made our soft landing. Let's get back to cutting rates that some analysts were expecting. However, just like we talked about last week, there's the narrative. There's what we think we know about how the market is going to interpret commentary like that. And then there's what's actually happening. And for my dollar, it's much better to work with what's actually happening than what I believe is the truth. And so we have seen falling price action on the 10-year interest rate here in the US since that commentary last Friday. Certainly pullbacks and stabilization within the interest rate yields has been very constructive for equity markets. And seeing this higher for longer narrative, maybe stabilizing around that 4% area could be that long-term stability that equity markets really need. As I was talking with Ari Wald this week, we were pointing out the fact that heightened interest rates, that is a sign of growth in the economy, and keeping some lid on runaway inflation is the job of the Fed. And so we don't have to fear higher interest rates, but we have to certainly to look at the inverse correlations between those spikes in yields and what we saw in terms of damage to the S&P during that 2022 cycle. So when we have runaway rates and runaway inflation, that can be very destabilizing. But what we're seeing right now is a lot of stability from the interest rates. Alex, talk to us a little bit about what you're seeing from a trend perspective here on this daily chart of the TNX.
Yeah, I mean, and as you said there, everybody, you think you'd love to have 0% rates, but of course that would mean we were in a terrible time, right? That's one of the ways we can combat a hard economic situation. So when you have, like you said, rising rates, but in a stable fashion or elevated rates, if we drew this chart out, which we could do in a minute, you'll see that we were at some sort of levels of resistance here. So when we fall away from it, that's showing us that perhaps we are in this area of more elevated rates around 4%, which could be quite healthy for markets. But specifically to your point, sorry, from a trend perspective, what we can see is that the go-no-go trend has painted a series of weaker aqua bars, which is showing some weakness in this go trend that we're seeing in the rates. But also, interestingly, on the lower panel here, go-no-go oscillator breaking back into negative territory, which we know is not what you'd expect for a strong go trend. So if these rates were to continue to rise, like you said, if we were worried about runaway rising rates, then the momentum would most likely be staying positive. So this is a sign that perhaps continued pullback. Certainly at the moment, we're seeing some weakness in the go trend for rates.
Now, as you pointed out, Alex, part of our process, either with trades, looking at multiple timeframes, or from an analytical perspective, having the chance to zoom out. Certainly, we make that part of our practice at the end of each month to look at even longer timeframes, monthly charts. But let's just look at the TNX here on a weekly basis to see how this price action over the last week in some of this move downward has just given us that that kind of steady range-bound chop.
Yeah.
Obviously, trading in choppy markets for trend followers can be really difficult, but a range-bound choppy market in things like the US dollar or interest rates is very healthy and stable for trends to develop in the equity sector. So it's nice to see that we didn't break out of this long-term channel and run away to the upside. Instead, we're remaining within that channel.
Absolutely.
So let's move on to a chart of the US dollar. Here at GoNoGo Charts, we like to use ETF proxies that gives us a sense of volume as well. We look at UUP for the dollar index fund. And we also, in our own work, look at a lot of relative strength maps. We look at currency maps. US dollar is still the place to be against almost all other global currencies, certainly within the G10. But from a trend perspective on the dollar index as a whole, we're still in the weaker go trend. But Alex, talk to us a little bit about what you're seeing on this chart.
Yeah, and like you said, we fell away again when we hit these highs, which line up with some earlier highs on the chart. But we did jump a little bit today. So today's equity prices not running away as we thought, perhaps they might. Obviously, this is not the end of the day on Thursday. We'll see what happens for the rest of the day and also how the week closes tomorrow. But today, it looks as if the dollar did find a little bit of support as the oscillator bounces off the zero line and stays in positive territory. So yes, we fell away from this high, but a little bit of strength in the dollar today.
And let's look at that on the weekly basis so we can see some of those areas of resistance, overhead supply, and get a better sense of where we're at going forward.
Yeah, I mean, we're right at an area of resistance. So you can see how last week, maybe you could argue we closed above it. This week, we've fallen back right to it. So you can see how the high here in the previous go trend, the sort of shorter term high here, that was the first sort of sign that we could use that as resistance. Remember, we talk about polarity a lot here, but this level has been a high, an area where the market has understood that this is a high price for the dollar for some time. And we are sort of right back there now this week, having come down a bit from last week. So very, very important level. Obviously, we can see that the oscillator is staying positive. So if anything at the moment in terms of the dollar, then we could say go trend in place, momentum on the side of the go trend. So we'll see whether or not we can really test that resistance level and get above it.
Absolutely. Before we get to our equity sectors and we start talking about the XLE, the energy sector, let's take a look at U.S. oil first and just get a sense of the trend in some of our commodities.
Yeah, for sure. And we've had, I mean, anybody that's been watching this show for any length of time has seen this chart before. And we were, following it for such a long time, trying to see whether or not it could get above this slowly sort of meandering no-go downward sloping resistance line. And of course, we noted over a month ago now that it did seem to break above that level. We also saw the oscillator break into positive territory out of a max go-no-go squeeze. So that was all very, very bullish signs for oil long-term on this weekly chart. And what we can see over the past month that we've seen that trend strengthen. It went painted aqua bars, came back perhaps to test the support at this level. But now we've seen a couple of weeks in a row now of strong blue go bars. And this week's been a very good week so far for USO.
Let's dive down to the daily level just to take a look at the price action over this last month as we've rallied out of that downward sloping trend channel and found ourselves some support.
Yeah, I mean, this is a healthy sign because we came out of this no-go correction. We've made a series of new highs, and then look at the oscillator. Even though it dipped to give us a bit of a sort of a fake out into negative territory, quickly back to the zero level, and now once again into positive territory. And that gives us this continuation icon. Remember, these green circles are trend continuation icons in a go trend, and we are right at this recent high. So continuation momentum coming back in the direction of the go trend. So we're going to look to see if price can perhaps make an attack on this prior high and go higher in the next couple of days.
Absolutely. Let's switch over to a chart of gold, just to get a sense of some precious metals action over this last week.
Yeah, it's been a good week all around. I mean, we've had this chart going for a while, and you can see that this move higher, this series of higher highs, punctuated by these corrections that come out as these no-goes, really has sort of turned around. And now we're looking at it in a slightly different vein. It now looks like we're making lower lows and lower highs with any kind of rally dipping into the go colors. So again, this could be another lower high. We'll watch to see whether we go higher from here or if this rolls over again. But you can see that we've been creeping lower, making lower lows and lower highs. This is a period of uncertainty, right? We've got a couple of amber go fish bars here, 3 actually. So there's some uncertainty, but momentum is positive. So some contradictions here in this chart, but we'll be watching closely.
Absolutely. Well, let's turn our eye to the U.S. equity markets. Let's start with a index level with the S&P 500, taking a look at that price action. As we started today's show, we were talking about how we want to be able to identify pullbacks within longer term or secular uptrends. And so a daily basis is going to give us, some shorter term price action. I think that's the right place to start. Certainly the constructive evidence in favor, as Alex mentioned at the beginning, is that we've been in neutral territory. So the trend following model, all of those indicators that are blended in the background, they're in neutral readings right now. That's where we're getting those amber bars on the price panel. But it's interesting to note that the GoNoGo oscillator, which was in negative territory through this no-go corrective phase over the last couple of weeks, rallied back up to the zero line, and through it, we have seen volume lighten up right here at this 4,500 level on the S&P 500, but we are back into positive momentum with a neutral reading on the trend identification. Alex, if you wouldn't mind, let's pop this out to a weekly chart just so we can see a little more longer-term context where we've come out of that 2022 bear market and into 23.
Yeah, I think it's such a great point that you bring up. We're always talking about multi-time frame analysis, and again, I think it's important to note that we believe that technical analysis can help any number of people in the industry. And so, excuse me, so we aren't sort of insisting anybody should trade a certain way, but you might want to, for people here that are interested in technical analysis, I'm sure so many people are, look up things like the Elder triple screen system, right? That idea of using multiple timeframes. And when you have your longer time frame like this in a strong go trend, then you would be diving down to the daily to find areas perhaps where the market's been beaten down. And then you go down another time frame to look for those specific entry points. So what we were just looking at on the daily chart is an area that's been in a no-go and has come into neutral. Maybe that rally itself is enough for you to, as a person looking at this long-term chart, say, I want to now buy the dip in this longer time frame. So not that we're going to suggest any specific way for people to trade or invest. It's very important to understand how you can use those multi-time frames. And we've been looking at the weekly. We zoom in a little bit. We were looking at this last couple of weeks and saying, okay, we're at the zero level here on the weekly. This may be an area where you look for trend continuation. And if that's the case, you're going to see it show up both here as you are with the oscillator bouncing off the zero line and in the daily. So however conservative you want to be with your entries, there's a number of ways you could use technical analysis, not just GoNoGo Charts, but technical analysis itself. Perhaps you're looking for renewed momentum while in a longer term uptrend, right? Perhaps the oscillator getting above zero into positive territory, like you highlighted on this daily chart, is enough for you to say, okay, now we're seeing that return to positive momentum, given that our weekly time frame is still a strong go. You might be waiting for the go trend on a daily chart, as it probably come in as we attack these prior highs. But just that idea of doing the research and studying multi-time frame analysis, I think, is very beneficial.
I think you make that point really well. We talk a lot in our educational series about responsible approaches to market analysis. Obviously, Alex and I don't know what tomorrow holds. Any analyst out there that's telling you they can predict the future is somebody to just turn off the TV. But what we do know is that we can take a responsible or objective approach to buying dips. This is not, diamond hands. This isn't buy anything that pulls back. The old adage for technical analysts is that we don't catch falling knives. We wait for movements to be completed before re-entry. And that's exactly the kind of process that we want to use GoNoGo charts to do, which is to identify momentum resurging in the direction of the underlying or the longer time frame trend. And then, of course, the trend model itself, whatever your time frame is. Alex, if you jumped this down to a 60-minute chart, we would have seen the Go trend appear much earlier. These last 3 days in amber bars are likely going to show up as strong Go blue bars on something like an hourly chart. So the time frame is up to you, but the concept of waiting for confirmation from the market itself that it is indeed resurging or the trend is coming back in the direction of that underlying or secular trend. That's what we're talking about as a responsible approach, not to simply throw your money at something that is in a downtrend in the hopes that that is just a buyable dip. So let's take a look at another index. Obviously, we pay a lot of attention to the S&P 500, an important benchmark for a lot of managers. But yes, the IWM, Alex, it's like you can read my mind.
It's amazing.
We've talked a lot on this show and with many of our clients about rotation and about market breadth and expansion within this bull market, that there's more participation, right? If you think about elite sports teams, it's not just one star player. There's a deep bench of great players on the team. They all have a job to do. And when we're thinking about the support of a bullish environment for stocks, we want to see more and more companies participating. So Alex has pulled up a chart of the Russell 2000. That's a small cap. We're looking at the ETF IWM. And the important point to pick out here, for those in the bearish camp that haven't seen the signs that we are out of the woods yet, done with that 2022 correction, they're pointing to the fact that small caps have not participated fully in this recent rally. And so a chart like this, and when we're thinking about our classic technical analysis, the kind of stuff that Ralph Acampora was talking to me about over a decade ago at the CMT Association, what we can do is visualize investor behavior. So in this chart of the Russell 2000, we certainly see an important resistance level. There is a shelf of former supply that we got to break through right around the 2000 level on the Russell 2000. Right now, we're sitting at 1905 on the index, and what jumps off of this chart is the lows. We have a series of higher lows in this ascending triangle. Forget what name you want to give the pattern. What it's telling us is that buyers are stepping in at higher and higher price points every time this price action pulls back. So we're getting folks stepping in and buying up small caps in the Russell 2000 at increasingly higher levels. And we recently made a significantly higher new low, new pivot point there on the IWM, and taking back off in the direction of that sort of constructive evidence. We're in a weak go trend. We're testing the zero line from a momentum perspective. We're going to see if that offers some support for momentum, and we can see the trend rally back to the top end of this pattern. And we'll wait for confirmation. That breakout above 2000 is obviously going to be very significant for the Russell. Once we are above it, then there's a lot of room to the upside. So just something to keep in mind in terms of participation and breadth of the market. We're seeing a lot of constructive evidence on the Russell 2000 as well. Alex, as we always do, let's get under the hood of the S&P 500. Let's take a look at our GoNoGo sector rel map. And for those of you who are using GoNoGo charts on your StockCharts account, the core chart is that single security that's got the trend, momentum, volume, and volatility all articulated. What we like to use with these heat maps and relative strength maps, we work with a lot of institutional clients. If you're one of those and interested in using these tools as well, feel free to shoot us a note, info@gonogocharts.com, and we'll make sure we can get you enabled. So Alex, talk to us a little bit about the relative strength of the sector groups versus the S&P 500.
Yeah, I mean, we've been watching this chart again for a couple of weeks now. We've been seeing the same picture emerge. It's been an interesting mix of communications and energy. We had healthcare as well last week, but that seems to have entered a period of uncertainty relative to the larger index. But we still have communications and energy in Go trends.
And of course, last week we spent a lot of time digging into the communications sector. We looked at the industry groups that were leading, both publishing and internet names within the industry groups of that rising communications sector. This week, let's talk a little bit more about energy and specifically take a look at the industry groups within that sector. I think it's important to note that as we've seen strength at the index level, right? We have a rising S&P 500 back into amber bars. We did see rotation from some of those cyclical sectors that aren't keeping pace with this newly rising S&P. So of course, paying attention to the communications names is going to be key, but we can also look into the energy sector for areas of leadership. Strong relative performance, beating the benchmark means that the energy sector is rising faster and further than what we have seen from the broad index. So Alex, talk to us a little bit about the industry groups that we're seeing in here.
Yeah, I mean, this is what we talked about in our note that went out on Monday, but the one that's been consistently outperforming is the oil and exploration subgroup. And so that's, if you think about your Valeros, those are your oil companies, and that's really where the consistent outperformance has been. There's been some other outperformance, obviously, but for a couple of months now, that's been the subgroup that's been able to outperform consistently. Of course, we've seen some strength recently in the coal index, but broadly speaking, it's been that oil and exploration that's been leading the way.
Absolutely. So let's switch our eye to a couple of individual names within that oil and exploration. Let's pull up a chart of Valero first. VLO is the ticker for those of you following along at home.
Yeah, Valero is a great chart. We looked at this earlier in the week, and it's actually quite nice because the same exact setup exists on a Thursday when we looked at this earlier in the week. And what's very interesting here is that we have a max go-no-go squeeze built in that lower panel. So we've had a real tug of war here, Tyler, between the buyers and sellers, and that's what you see reflected as that go-no-go squeeze grid builds to a max. That tells us that there's little directional momentum, even though the trend that is in place is a go trend. So we know how important the zero line is. We know that there's a go trend in place, but as prices have come off this recent high, the oscillator has fallen to and stayed at the zero line, which tells us we're sort of waiting to see which way momentum goes. And what we would like to see, what we would expect, given that the go trend is already in place, is that the squeeze is broken into positive territory, and that would give us continuation. And what we were talking about earlier is that we know energy is outperforming the broader market. We know that the market itself has turned around a little bit this week. We know that equities in general are in a larger time frame go trend from that weekly chart, the S&P. So why not drop down to within an outperforming sector and an outperforming subgroup to find a security that might be setting up for trend continuation? So that's what we're looking for here. This might be an opportunity to certainly buy this dip if we get the momentum breaking the squeeze into positive territory. And if we back this out to a weekly chart, it's also very interesting because we have seen a return to a go trend on the weekly chart as well after breaking out of this max go no go squeeze. So yes, there's a lot of overhead supply right here, but weekly chart back in a go trend, daily chart setting up for some trend continuation possibly. So we'll be watching closely to see if these kinds of securities can continue to outperform.
You know, and as we talked at length in the educational series, when we're thinking about volatility compression, that can take place in one of two ways. We can look at trend continuation, right? So you get a max squeeze, you see a tightening range of price action, you see that tug of war between buyers and sellers show up on the go-no-go oscillator when we're seeing neutral momentum. It can also take place in a trend reversal, right? So it's all about the ultimate decision between buyers and sellers. What shakes out in that tug of war is going to give us the leading indicator. The signal break is what's most important. So when we see that go-no-go max squeeze, we're open to all possibilities. If it
Mhm.
breaks to the downside, then we're going to see price action follow. And from those volatility squeeze breaks, particularly a prolonged max squeeze like that, if that breaks to the downside, then all bets are off, and we'll be looking for potentially high velocity price moves to the downside following that negative momentum. All else being equal, as Alex said, we're in a go trend. We've come up to this area. We're consolidating and narrowing the price action. A trend continuation environment would make sense if we see the GoNoGo squeeze break to the upside. So a return to positive momentum. Now, Alex, our process and our approach, looking at relative strength by the sector groups, then diving into the industry groups within those leading sectors, it's to try to put probabilities on our side, right? We want to own the things that are outperforming the index. We're going to look into the sectors and industry groups that are outperforming the index. But to conclude today's episode, let's talk about a couple of the high flying, the large mega cap tech names and consumer discretionary names that were the heroes of the 2020 and 2021 rally. Let's pull up a chart of Google to begin with. And as we started this episode, we talked about the objective approach to buying into pullbacks and dips. Where is that point of resurgence? Where do we want to see our trend continuation? Let's start with Google on a weekly basis here at the end of August, and we're going to be looking at monthly charts all weekend. Here we're seeing that strong go trend for Google. We have positive momentum, a couple of retests of that zero line in the early summer, midsummer in July when we saw that pullback. We have since moved substantially higher and retained that positive momentum. Now let's dive back into that daily chart, Alex, and talk about where we're at this week here on Thursday, August 31st.
Yeah, and interestingly, on the daily, we're breaking higher out of this sort of horizontal move that we saw, horizontal range. We saw this max GoNoGo squeeze build. We saw it get broken, return to zero, and then back into positive territory again. So all good signs on Google here that a go trend is in place on both the daily and the weekly.
Let's take a look at Apple real quick.
Yeah, Apple, I like this one because it reminds me a little bit of what we were seeing on the S&P 500. And if we are returning to some positive price action on the equity market as a whole, right? Remember, we were in a larger time frame weekly go trend that was showing some strong momentum and strong go bars. And on the daily chart, we were seeing that go fish, but with positive momentum. Well, what drives that major index is these massive mega cap tech stocks to some extent. And you can see the same sort of setup here. So if you're looking for a way to participate in some kind of return to strengthen the equity markets, these mega cap stocks are setting up in a similar kind of way where we're seeing positive momentum for the first time after this correction. And we're seeing some uncertainty represented by these amber bars. So you could be early on if you're waiting for that go trend or that go to be identified. Now, of course, all else being equal, we look at these colors and we know that this is a bit of uncertainty, but it's a very similar setup to what we're seeing in the S&P as a whole.
Absolutely. That break above the gap down right around 190 would certainly be a very constructive bit of evidence for Apple. And let's talk about the options traders' favorite. Let's take a look at Tesla. Consumer discretionary had a couple of big days this week. The highest performing sector on Tuesday, and here we're seeing again a very similar setup coming out of the woods from that no-go corrective action back into amber neutral bars, and the GoNoGo oscillator back above zero. Alex, talk to us a little bit about your interpretation of this chart.
Yeah, and heavy volume as well. You can see that the volume has been heavy since this low. The volume's come in quite strongly, and it's back again. It's sort of a little bit of an ease off here, but we're back to the darker blue of the oscillator, which tells us that volume is heavy relative to its recent history. So we're getting amber bars, we're getting heavy volume. We're looking as if the no-go hold has sort of given up its grip for at least the last few days as prices rallied off this low. We're going to watch to see if we can get anywhere near this old high and see if we can perhaps make new highs. But certainly early days, if we're looking for these mega caps to drive markets higher, we might be catching some new goes coming in the next couple of days.
Absolutely. So from all of us here at GoNoGo Charts, thank you so much for tuning in each week. I can't tell you how happy I am to have Alex back on the show. Makes for a much more lively discussion, and hopefully you've enjoyed today's episode. What's great about this virtual environment is we can come right to your home or office every single week with the GoNoGo show. But I'd also like to invite all of you to get on a plane or jump on a train or a car and join us in Las Vegas at the end of September. The great David Keller of StockCharts TV fame and the Final Bar host is going to be joining me at 2 back-to-back conferences at the Wynn Hotel in Las Vegas. We're going to dive into a lot of GoNoGo Charts material and cover investing from a number of different angles over those 4 days. We'll make sure there's links in the show notes below, but come do some 3D networking with the GoNoGo Charts team if you can. That'll be September 21st through the 24th at the Wynn Hotel in Las Vegas. And until next week, take care of each other and trade them well.